Wes, good to see you. Today we are discussing 4 bond alternatives that we should be considering right now. And I want to jump right into this because this is really interesting. And you know this already. But the 60/40 portfolio recently saw the second worst 6-month period in the last 50 years. Both stocks and bonds are declining here. So, in retirement, we need a stable income. Can bonds be considered that safe investment?
They've certainly been challenged this year, haven't they, Aaron? And see,
Yeah.
we've been in this declining interest rate environment for about really the last 30 years. And now we're on the other side of this where interest rates are rising. So a 60/40 portfolio over the last 30 years has actually averaged about 9%, which, hey, that's a great rate of return. And it also has minimized risk as far as comparing it to the pure S&P 500. But in today's interest rate environment, as you mentioned, Aaron, this is becoming very challenging. So that portion that is in bonds right now that's been getting hammered because as interest rates go up, bond values go down. And here we are trying to deal with this. And as retirees, everybody who's trying to pull money out of their portfolio in this environment, it's very, very difficult. So we have to have some alternatives, some things that are a little bit different, get a little bit creative.
Right. So let's walk through some of the alternatives that you are recommending. And top of the list here, fixed annuities or fixed index annuities. I feel like there's kind of a love-hate relationship with annuities.
Well, there's lots of different ones out there, and sure, there are some that perhaps aren't the best for you. But if it's evaluated properly, the style that could fit within your plan could make a whole lot of sense. So a fixed annuity is much like a CD that's offered by an insurance company because it's paying a fixed rate. It's a fixed principal for a certain period of time. So it could be 1 year, it could be 3 years, it could be 5 years, 7. And then you have a fixed index, meaning that your principal is fixed, but the interest that is earned is linked to the performance of an underlying index. So again, that's usually going to come with a certain cap or participation rate. Can get a little bit confusing, but they can be great tools if it's implemented properly.
Yeah, right. So the second thing here, buffered or defined outcome ETFs. What are those?
These are really cool. So it's actually an exchange traded fund, and it's using a strategy that provides you with a defined outcome, just like the name.
Mhm.
So you can have exposure to, say, the S&P 500 that has a downside buffer. Maybe that's 9%, 15%, or even something like 30% downside buffer. But the more buffer that we have, we would expect to have a corresponding cap to the upside. So we have that defined outcome where we could have certain exposure to the upside, but also having that defined downside, which is really important when it comes to managing risk and managing volatility within a retiree's portfolio.
Mhm. Okay, and third on your list here, I've been hearing a lot about these lately, real estate investment trusts or REITs.
So just another financial tool and a way to generate income within a portfolio. We think that REITs, can have their own challenges in this environment, but that doesn't make them all a bad thing. But if they're in the right sector, it's real estate that your portfolio is invested in that can provide income, and sometimes that yield can be quite attractive, anywhere from say as example 5 to 8%, depending on the particular REIT.
Yeah, okay. And last on your list, cash value life insurance. Tell me about that.
This is a different kind of life insurance. So typically when we think of life insurance, we think about, having a policy where you pay the least amount of premiums possible to have the
Mhm.
greatest death benefit. That would be your traditional term insurance. This is different. Cash value life insurance is designed to build up a bucket of cash within the policy, kind of minimize the death benefit if it's built properly, but the cash within can either earn at fixed rate or it can earn something like a fixed indexed annuity does in a similar manner, in that if, say, the S&P 500 is up year over year, then you get a percentage of that gain. But also if it's down, you're saved there. But it's a way that you can generate income in a portfolio, and properly structured, Aaron, you can actually take money out of these tax-free, which is really cool too.
Right. All right. Well, I feel better after talking this through with you because it's nice to know that there are options out there. I'm sure though there's a lot of value to talking this through. So if somebody has questions, what's the best way to reach you?
Simply reach out to us, whether that's by phone at 919-322-4113, or shoot us a quick message at info@patriotwealthnc.com.
All right. Wes, thank you very much.